All right, if you work from home here in the UK, you are definitely going to want to pay close attention. The rules around what you can claim are changing, and HMRC is looking at home office expenses like never before. One little mistake could cost you thousands, but getting your head around this new landscape could save you a small fortune.
So, let me ask you this. Are you 100% sure you're making the most of your deductions? Or, and be honest, could you be accidentally claiming too much and leaving yourself wide open for an investigation? It is a very, very fine line.
Now, to help us navigate this tricky area, this entire breakdown has been put together with the help of the experts at My Tax Accountant. They've given us the inside track on exactly what you need to know for the 2025/26 tax year.
Okay, let's get right into it. To even start to get this right, you have to understand one single fundamental principle. It's HMRC's golden rule, the wholly and exclusively test, and knowing what it means is completely non-negotiable.
So, what on earth does that actually mean? Well, the most important word on this slide is solely. This is the official definition. An expense must be for your business and only for your business. If it has a dual purpose, part business, part personal, and you can't cleanly split the two, HMRC can and will disallow the entire claim. It's not about a 50-50 split, it's all or nothing.
And this makes it crystal clear. Let's imagine Sophie, a freelance designer working from her flat in London. The bit of her council tax that relates to her office space? Yes, that's allowable. A completely separate phone line just for clients? Perfect. But her entire mortgage payment? No way. That has a clear personal benefit. It keeps a roof over her head. What about a business trip to Scotland where she tacks on a long weekend to go hiking? That trip now has a dual purpose, and the whole cost of the travel is disallowed.
So here's a little pro tip for you, and this could save you a major headache. For those mixed-use costs, like your personal mobile phone, the burden of proof is totally on you. You need to have a reasonable, logical way of separating the business use. That means you have to be prepared to go through your bill and highlight every single client call. You can't just pluck a percentage out of thin air.
Right, so you understand the big rule now. But how do you actually apply it? Well, when it comes to your home office, you've basically got two main paths you can go down.
So here are your choices. On one side, you have the simplified flat rate. It's exactly what it says on the tin. Easy, quick, not a lot of paperwork. On the other side, there's the actual costs method. Now, this one's more work, there's no doubt about it, but it could also lead to a much, much bigger tax deduction.
Let's look at that simple method first. HMRC gives you a fixed amount each month, and it's all based on the hours you work from home. It kicks off at £10 a month if you're working between 25 and 50 hours.
Then, if you work a bit more, somewhere between 51 and 100 hours a month, that amount jumps up to £18.
And it tops out at £26 a month for anyone working 101 hours or more. See? It's a safe, easy option, no receipts needed. But the real question is it the best option for you financially? This table really breaks down that choice beautifully. The simplified method is great if your extra costs are pretty minimal. But if you've got a dedicated home office and your energy bills are going through the roof, then the actual cost method lets you claim a fair percentage of your rent, your mortgage interests, utilities, council tax, the whole shebang. It really is a trade-off between keeping it simple and making sure you get every penny you're entitled to. Now stay with me, the next point might surprise you.
That's not all. Here's where most people go wrong. They just assume the rules stay the same year after year. Well, they don't. The landscape is shifting, and HMRC is signaling a major, major crackdown.
Just take a look at this timeline. In the autumn budget of 2025, a huge change was announced. From April 2026, this specific tax relief for employees working from home is being completely abolished, gone. This is a massive U-turn from the rules we all got used to during the pandemic.
And you might be asking, why are they doing this? Well, this quote from the government's own policy paper tells you everything you need to know. They checked a bunch of claims and found that over half of them were ineligible, more than 50%. That's a huge level of non-compliance, and it has put HMRC on very high alert.
So what does this actually mean for you if you're self-employed or a company director? I mean, the employee rules don't directly apply, right? Well, this is a huge signal of intent. Even though your rules haven't changed yet, the whole game has. This move against employees shows that HMRC is now actively looking for and challenging incorrect home office claims right across the board. The era of getting the benefit of the doubt is well and truly over.
So we've covered the day-to-day claims. But there is a massive long-term trap that could cost you tens of thousands of pounds when you eventually sell your home. And it's something so many people just stumble into completely by accident.
The question is simple, but it's also pretty terrifying. Could being a bit too enthusiastic with your home office claims today land you with an enormous capital gains tax bill tomorrow? For a lot of people, the answer is a scary yes.
Okay, here's exactly how it happens. To try and maximize your claim, you might argue that your spare bedroom is used exclusively for your business, 100% of the time. In doing that, you've just officially told HMRC that a part of your house is now no longer a private residence. It is now, in their eyes, business premises. And that means it loses its valuable protection from capital gains tax. So when you sell your home, the profit you make on that room is now taxable.
And this just shows you how painful that can be. Let's say you make a £120,000 profit when you sell your house. Amazing. But you've been claiming one room, maybe 30% of the property's value, was exclusively for business. Well, look at this. The tax relief now only covers $84,000 of your profit. That leaves $36,000 completely exposed to capital gains tax. That's a potential tax bill of over 10 grand, all from trying to claim a few £100 extra each year. It's not worth the risk.
Okay, so with all that in mind, the new scrutiny, the hidden tax traps, what should you actually be doing right now? Let's pull all of this together into a clear, simple action plan.
First things first, review your claim method. Is the safety and simplicity of the flat rate actually a better deal for you in the long run? Second, if you use the actual cost method, your records have got to be absolutely perfect. Third, and this is probably the biggest takeaway today, avoid claiming exclusive use at all costs. Make sure your office has some other purpose, even if it's just minor. Use it for personal admin, keep a bookshelf in there. This is what protects your home from capital gains tax. And finally, understand your risk, and most importantly, get some professional advice.
Look, navigating all of this is seriously complex. And as we've seen, the stakes are just too high to guess. For tailored advice that fits your specific situation, your best bet is to talk to the experts at My Tax Accountant. They can give you the clarity you need. You can reach them on 0208-570-8531, or you can email them at info@mytaxaccountant.co.uk. Just before we finish, it's really important to say that the information in this guide is for general purposes only. You shouldn't rely on it exclusively to make financial decisions. Before you make any decisions, you must consult the tax experts at My Tax Accountant.